matches to your 401k or 403b, or maybe it's a 457 plan. You want to try to max out these employer plans. Okay. So check your contributions. Right now is a great time. You might have a little bit of downtime over the holidays. Check your contributions. For 2025, the deferral limit is $23,500 per person. That's the maximum that the IRS allows you to put into that 401k or 457 or 403b. Remember, when you put that in, if you put it in a traditional 401k, it's kind of similar to what Lori and I talked about in the last segment. So if you make 50,000, you put 10,000 in your 401k, you're actually only being taxed on 40. So it's an easy way for you to reduce your taxation and save for retirement. If you're over 50, you can contribute an additional $7,500 this year. And even if you can't max out, increasing those contributions before year end can make a big difference.
Now, is that $7,500? Or that's something new this year? Because I know before you said tax laws had changed.
Yeah, that is not new. However, it's not one of the things that is newer is there is a supermax contribution between ages 61 and 63 where you can put in additional monies for this year, beginning this year. So we are getting a little bit more friendly with those folks working a little bit longer. So yeah, the next category that I want to touch is your IRA contributions and those Roth conversions. So you can put into a traditional IRA. You can actually put into a traditional IRA, Lori, all the way up until the tax filing deadline the year after. So even if you do forget that, just remember you can do that all the way up to your tax filing deadline. But your traditional IRA contributions may be deductible, so those, again, can lower your taxable income. Your Roth conversions allow you to move money from a traditional IRA into a Roth. And what that allows you to do, folks, is you pay taxes now, but you avoid them later. Okay. If you're in a lower bracket this year, it might be worth considering. That's something that we've done quite a bit of this year for folks.
Okay.
So you want to check with your advisors on that. They have calculators they can run for you. If you are over age 73 and you have money in an IRA, maybe you put money into a 401k when you were working, maybe it was a pension that you rolled into an IRA. Remember, and this is really important, we have a few clients that we're still getting together with. Before the end of the year, you need to take out what's called a required minimum distribution. If you're out there and you're over age 73, you're probably familiar with this term. If you do not take that money out by the end of the year, the penalty is 50% of the amount you were supposed to take.
Ooh, so you have to withdraw money. Is that what that is?
Correct.
So go on a trip. If you got to take that money and get out of here.
That's right.
Yeah. So
that's right. So
they're making you take it out. Now let me ask you this: if you take it out, can you put it back in, or is that something tricky that I can't ask you on the radio?
No. You can absolutely put it back in, and that's a great question. It's just not what you're doing. It is, Lori, you're taking it out of one account, out of your IRA account, and you can put it in a brokerage account. Okay. And just reinvest the proceeds.
Okay.
We have clients that do that all the time. And so that money just needs to be and really the reason that, that this isn't in an IRS regulation is because if you think about it, Lori, you deducted that money off your taxes when you were working. So using that example, if you made 50 grand, put 10 grand in, you told the IRS you only made 40, that 10 grand's never been taxed. It never gets taxed from year to year. It grows. So the IRS is saying, hey, we want you to claim a little bit on your taxes when you get to a certain
They want
age.
some money.
Correct.
Okay, I got you. All right,
Correct.
okay. All right.
So then we talked about charitable giving. Donating appreciated stock instead of cash can reduce your capital gain taxes. So if you're over age 70 and a half, qualified charitable distributions from your IRAs allow you to give directly to charity. This is really important, Lori. We have a lot of clients that do this. Clients that have already been giving to their church. They've already been maybe giving to, the Red Cross or the Cancer Society or another charity that they're passionate about. Instead of doing that from your checkbook, I want to encourage every one of you who are out there who are 73 or over to consider taking money from your IRA and giving it directly to charity because you have to pay no tax on that. That's key.
Okay.
So you're still going to get that standard deduction of $15,000. But if you let's say you take 10 grand out, you give it to your church, you don't pay tax on that 10 grand. The church doesn't pay any tax on it. So it's an easy way. It's called a qualified charitable donation. The
that's pretty smart.
Yeah, absolutely. And then the last thing that I want to hit here, and this is an important one as well, tax loss harvesting. So if you have investments, and I know the market has done really well this year, and it's been a really good run here over the last 3 years, but if you have investments that have, maybe you bought stock at $100 a share, maybe that stock is $80 a share, and you just haven't sold it. Okay. There's something called tax loss harvesting. So I had an example of this. Let's say you sold some stock earlier in the year and you made a $10,000 profit on that stock, but later you notice another investment is down. Let's say that in that example, it's down $7,000. So if you sell that losing investment before December 31st, you can now use that $7,000 loss to offset that $10,000 gain. And so instead of paying taxes on that full $10,000 gain, you'd only owe taxes on $3,000. So if you had no gains at all, you could use up to $3,000 of loss to reduce your taxable income this year. And then you can carry that remaining $4,000 forward to offset gains in the future years. Now, there's an important note. I want you to know about the wash sale rule. So I wanted to make sure we go over that. And that's that covers it.
Okay. So that is the washout rule with the 3,000 you just talked about.
Correct.
Okay. All right. So it's not about cutting losses, it's about using them strategically.
Exactly. Tax loss harvesting turns a negative into a positive.
All right. Well, I learned some things there, Kevin. Especially, I love it when you teach us how to not have to pay taxes on something. That's always helpful. So, I'm with Kevin Norman, certified financial planner with Compass Investment Group. We're going to come back and for segment 3, and we're going to talk about broader financial checkpoints. You are listening to Compass Corner